Welcome to Mindspace Capital Focus, your hub for smart investing and financial growth strategies. In this video, we'll explore how to spot undervalued companies, Buffett style. Whether you're a beginner or an experienced investor, understanding Warren Buffett's approach to finding undervalued companies can transform the way you make investment decisions. Let's dive in and learn the principles that have helped one of the greatest investors of all time identify hidden opportunities in the stock market. When it comes to spotting undervalued companies, Warren Buffett emphasizes a simple yet powerful principle: buy a great business at a fair price, rather than a fair business at a great price. The first step in his approach is understanding the company's fundamentals. Buffett doesn't just look at stock price charts or short-term market trends. Instead, he dives deep into financial statements, revenue streams, profit margins, and long-term growth potential. He believes that an undervalued company is one where the intrinsic value, the true worth of the business, is significantly higher than its current market price. To calculate this, Buffett examines key indicators such as earnings, debt levels, and consistent cash flow. He avoids companies that rely heavily on debt or have unpredictable earnings. Buffett also looks for competitive advantages, often called moats, that protect the business from competitors. These can be strong brand recognition, proprietary technology, loyal customer base, or cost advantages. A company with a wide moat is likely to maintain profitability even during economic downturns, making it a safer long-term investment. Another crucial factor is management quality. Buffett only invests in companies with trustworthy, competent, and shareholder-oriented leadership. He studies how managers allocate capital, their honesty in reporting, and their commitment to long-term value creation. Poor management can destroy even the most promising business. Buffett's method also requires patience. He advises waiting for the market to undervalue a high-quality company rather than rushing into trendy or speculative investments. Timing matters less than the underlying value. A great company bought at the right price can yield extraordinary returns over time. In short, spotting undervalued companies Buffett style is about a combination of deep financial analysis, understanding competitive advantages, trusting strong management, and exercising patience. By following these principles, investors can focus on true value rather than market noise, ultimately making smarter investment decisions. How to spot undervalued companies, Buffett style, deep dive. Warren Buffett's approach to identifying undervalued companies goes far beyond glancing at stock prices or market trends. He focuses on the essence of the business itself, its long-term earning potential, competitive advantages, and management integrity. In this part, we'll explore in detail the steps Buffett takes and how you can apply them in your investing strategy. 1. Understanding intrinsic value. At the heart of Buffett's method is the concept of intrinsic value, the true worth of a company based on its fundamentals, not the market hype. He calculates intrinsic value by analyzing earnings, assets, liabilities, cash flow, and growth potential. A company might look cheap based on stock price alone, but if its business model is unstable, it is not undervalued in Buffett's eyes. Buffett often says, "Price is what you pay, value is what you get." This means that investors should not chase low stock prices blindly. Instead, they should focus on how much the company is actually worth in terms of sustainable profits and future potential. This requires deep research, patience, and a disciplined mindset. 2. Financial metrics Buffett prioritizes. Buffett relies heavily on several key financial metrics to evaluate undervalued companies. Return on equity (ROE) measures how effectively a company uses shareholders' equity to generate profits. Buffett looks for companies with consistent and high ROE over time. Debt-to-equity ratio. Low debt is crucial. Buffett avoids companies with excessive debt because it increases financial risk and can cripple a company during economic downturns. Earnings consistency. Steady earnings growth over years indicates a resilient business. Erratic profits may signal volatility or poor management. Free cash flow. Cash a company generates after accounting for capital expenditures. Positive and growing cash flow ensures the company can reinvest, pay dividends, or weather tough times. By combining these metrics, Buffett builds a quantitative foundation to identify businesses that the market has undervalued. 3. Competitive moats. One of Buffett's most famous concepts is the economic moat, a sustainable competitive advantage that protects a company from competitors. Examples include brand strength. Companies like Coca-Cola benefit from global recognition and customer loyalty. Network effects. Platforms like Visa or MasterCard gain value as more users participate. Cost advantages. Companies that produce goods more efficiently or at lower costs than competitors. Regulatory barriers. Some industries require licenses or meet high compliance standards, making entry difficult for new competitors. Buffett insists that a wide moat allows a company to maintain profits and market share for decades, making it a prime candidate for long-term investment. 4. Management quality. Buffett invests not only in businesses but in people running those businesses. He looks for management teams that are transparent and honest with shareholders, allocate capital wisely, reinvesting profits into high-return projects, focus on long-term value, not short-term stock price movements, have a clear track record of performance, showing skill and discipline in past decisions. Buffett avoids companies where management acts in self-interest or lacks a clear vision. He believes poor leadership can ruin even the best business. 5. Margin of safety. Buffett's philosophy always emphasizes risk control. He advises buying a company only when its market price is significantly below intrinsic value, providing a cushion against mistakes or unforeseen market events. This margin of safety is essential to protect capital and reduce downside risk. 6. Patience and discipline. Buffett repeatedly highlights the importance of patience. He waits for opportune moments to invest, often ignoring market noise or short-term volatility. Instead of chasing popular trends, he focuses on timing aligned with value, ensuring long-term gains. 7. Understanding the business model. Buffett invests only in companies he can fully understand, what he calls his circle of competence. He avoids businesses with overly complex models or unpredictable revenue streams. The simpler the business and the easier to predict its profits, the better the chance it is undervalued. 8. Real-life examples. Coca-Cola. Buffett invested when the company was temporarily undervalued due to short-term market concerns, ignoring daily fluctuations in stock price. American Express. He bought during a crisis in the 1960s, recognizing the company's strong brand and moat, which competitors could not replicate. Geico. Buffett invested early, spotting the company's scalable business model and efficient operations, which promised future growth. These examples highlight Buffett's methodical approach. He combines deep financial analysis, moat evaluation, management assessment, and timing to make high-conviction investments. 9. Avoiding emotional decisions. Buffett's approach also teaches that investors must avoid letting emotions dictate their decisions. Greed during market booms and fear during downturns can lead to mistakes. Instead, following a structured process and focusing on value helps investors stay rational. 10. Summary. Spotting undervalued companies. Buffett's style is not about luck or guessing market trends. It's about careful analysis, disciplined patience, risk management, and understanding the true value of a business. By applying these principles, investors can make more informed decisions, minimize losses, and maximize long-term growth potential. Mastering Buffett's strategy to spot undervalued companies. Extended deep dive. Warren Buffett's method of identifying undervalued companies is a blueprint for disciplined investors, and it goes far beyond simply scanning stock tickers or following market hype. In this section, we will explore, step by step, the complete framework he uses, illustrated with examples and actionable insights. This part is designed to be extensive, offering a comprehensive 5 to 10 minute script for a video that teaches viewers exactly how to apply Buffett's investing principles. 1. The principle of value investing. Buffett follows Benjamin Graham's philosophy of value investing, which emphasizes buying a high-quality company at a price below its intrinsic value. Unlike traders who chase short-term gains, Buffett seeks companies with stable earnings over the years, strong competitive advantages, predictable cash flows, management focused on long-term growth. By targeting companies where the market undervalues the true potential, he minimizes risk and maximizes the probability of long-term gains. 2. Calculating intrinsic value. Intrinsic value is the cornerstone of Buffett's investing approach. It involves a careful analysis of a company's fundamentals, including revenue and profit trends. Is the company consistently profitable? Cash flow analysis. Can the business generate cash to reinvest or return to shareholders? Debt levels. Does the company rely on excessive borrowing, which could compromise its stability? Growth potential. Is there room for the company to expand its market share or diversify its offerings? Buffett never invests blindly. He evaluates whether the current market price is significantly below this intrinsic value, providing a margin of safety in case of errors or unforeseen events. 3. Economic moats. The secret to sustainable success. Buffett invests in companies with strong economic moats, meaning they have sustainable competitive advantages that protect their profits and market share. Examples include brand recognition. Coca-Cola's global brand loyalty keeps competitors at bay. Cost advantages. Efficient producers can maintain margins even when prices fluctuate. Network effects. Visa or MasterCard become more valuable as more users join. Legal and regulatory barriers. Some industries have entry restrictions, preventing new competitors from easily gaining ground. Companies with wide moats allow Buffett to hold them for decades, benefiting from consistent returns and compounding growth. 4. Management quality. Buffett evaluates not just the company but also the people leading it. He looks for integrity, transparent, honest leaders who act in the interest of shareholders. Capital allocation skills. Management should reinvest profits wisely and avoid risky ventures. Long-term focus. Executives should prioritize sustained growth over short-term stock price fluctuations. Track record. Past performance is a reliable indicator of future decisions. Strong management is often the difference between a company surviving economic downturns or collapsing under pressure. Buffett invests only in leaders he trusts completely. 5. Margin of safety. One of Buffett's most repeated lessons is the importance of a margin of safety. This principle ensures that investors pay less than the intrinsic value of a company, reducing the risk of permanent capital loss. For instance, a stock might trade at $50 but have an intrinsic value of $80. By purchasing at $50, investors gain a 37.5% margin of safety. Even if market conditions worsen or assumptions are slightly off, the investment retains value. 6. Patience over impulsiveness. Buffett emphasizes waiting for the right opportunity. He does not invest every day or react to market noise. Instead, he avoids chasing popular trends, waits for quality companies to become undervalued temporarily, holds investments for decades to allow compounding to work. Patience is as critical as analysis. Without it, even the best investment ideas can fail. 7. Circle of competence. Buffett stresses the importance of understanding the businesses you invest in. He calls this your circle of competence. Stay within industries or companies you understand deeply. Avoid complex or unpredictable business models. By focusing on what you know, your probability of success increases dramatically. 8. Examples of Buffett's approach. Buffett's strategy can be seen in real-life investments. Coca-Cola, bought when undervalued due to temporary market concerns, the brand's moat ensured long-term profits. American Express, purchased during a financial crisis, the company's loyal customer base and brand strength guaranteed recovery. Geico, recognized early for its scalable and efficient business model, leading to massive long-term returns. These examples highlight that Buffett combines financial rigor, moat evaluation, management assessment, and timing for maximum effect. 9. Risk management and emotional control. Buffett teaches investors to separate emotions from decision-making. Market hype, fear, or greed can lead to poor choices. By adhering to value principles, avoid panic selling during downturns. Ignore short-term market noise. Focus on intrinsic value rather than price fluctuations. Emotional control is vital to long-term investing success. 10. Key takeaways. To spot undervalued companies Buffett style, remember. Focus on intrinsic value, not market price. Invest in companies with wide economic moats. Analyze management quality thoroughly. Buy with a margin of safety. Stay patient and disciplined. Stick to your circle of competence. Avoid emotional investment decisions. By following these principles, investors can identify opportunities the broader market overlooks, manage risk, and achieve long-term wealth creation through smart, disciplined investing. Buffett's ultimate strategies for long-term investing, extended deep dive. In this final and extensive part, we will explore Warren Buffett's ultimate strategies for creating lasting wealth through investing, showing viewers how to think, analyze, and act like one of the world's most successful investors. This section is designed to be very detailed, suitable for a long-format video of 7 to 10 minutes, and it focuses on actionable lessons drawn directly from Buffett's teachings. 1. Think like a business owner, not a trader. Buffett repeatedly emphasizes that investing in stocks is like buying part of a business. He does not focus on daily market fluctuations or short-term gains. Instead, he evaluates the company's business model, how it makes money and its sustainability. Long-term growth potential, whether it can consistently generate profits over years or decades. Competitive positioning, the company's advantage over rivals and barriers to entry. By thinking like a business owner, investors avoid panic selling and can make decisions grounded in fundamentals rather than fear or hype. 2. Focus on quality over quantity. Buffett never diversifies excessively or buys numerous mediocre stocks. He prefers fewer high-quality investments where he understands the business deeply. Key factors he considers: consistent earnings and profitability, strong brand or market recognition, management integrity and competence, financial health, including cash reserves and low debt. Quality investments compound over time, creating far greater wealth than a portfolio of high-risk, unpredictable stocks. 3. Patience and the power of compounding. Patience is one of Buffett's most repeated principles. He famously said, "Our favorite holding period is forever." The power of compound growth allows money to grow exponentially. Reinvested profits generate returns on top of returns. Businesses that consistently reinvest earnings can expand and dominate markets. Investors benefit from long-term trends rather than short-term speculation. Understanding compounding changes the way investors approach time and risk, emphasizing long-term thinking over immediate gratification. 4. The importance of intrinsic value. Buffett's hallmark is buying companies below their intrinsic value, often with a significant margin of safety. This protects against mistakes or market volatility. He carefully calculates earnings potential over multiple years, cash flow generation and reinvestment ability, price relative to intrinsic worth. By purchasing undervalued companies, investors limit downside risk and create opportunities for extraordinary returns when the market recognizes the true value. 5. Avoid the noise, stick to your circle of competence. Buffett warns against chasing trends, speculation, or investing outside your circle of competence. Key points: only invest in industries or businesses you understand deeply. Ignore market hysteria, hype, or fear. Evaluate opportunities based on fundamentals, not headlines. By focusing on areas you understand, you reduce mistakes and increase the probability of long-term success. 6. Risk management through simplicity. Buffett avoids complex strategies and leverages simplicity as a risk management tool. Avoid unnecessary debt or highly leveraged positions. Invest in businesses with predictable cash flows. Hold sufficient cash for opportunities during market downturns. Ensure a margin of safety in every purchase. This disciplined approach ensures investors survive market crises while others panic or lose capital. 7. Psychological discipline. Buffett emphasizes controlling emotions and remaining rational. Key psychological traits include patience, wait for the right opportunity; detachment, avoid emotional reactions to market swings; confidence, trust your analysis without being swayed by the crowd; focus, concentrate on long-term wealth, not short-term speculation. Investors who master the mental aspect of investing have a significant advantage over impulsive or reactive participants in the market. 8. Learning from mistakes and continuous improvement. Even Buffett makes mistakes, but he analyzes them thoroughly, adjusts his strategy when necessary, never repeats avoidable errors. Investors should review past decisions, understand what went wrong, and refine their approach. Continuous learning is central to Buffett's success. 9. Combining all principles for wealth creation. When combined, these principles create a systematic approach to long-term investing. Analyze intrinsic value. Focus on quality companies with moats. Think like a business owner. Maintain patience and discipline. Stay within your circle of competence. Manage risk with simplicity and margin of safety. Control emotions and psychological biases. Learn from mistakes. Following these steps, even average investors can emulate Buffett's approach and achieve consistent wealth accumulation over decades. 10. Key takeaways. Investing is not about speculation, it's about owning businesses. Focus on long-term value rather than short-term fluctuations. Quality, patience, and psychological discipline matter more than market timing. Avoid complexity and unnecessary risk. Learn continuously and refine your strategy.